Most people think that investments fail because they chose the wrong stock, or they didn't have enough money at the right time, or the market crashed. In reality, most investments fail because the investor needed the money at the wrong time. A good investment can still be a bad decision if the timing is wrong. If there's a chance that you will need your investment for a possible emergency, then it doesn't belong in the stock market. Hello everyone, my name is Mudupe, and today let's talk about growing your money. Before we talk about what to invest in, there's one other question that is actually more important, and that is when you will need that money back. Because time is the one factor that can make or break any investment. Now here's what you need to remember. A good investment can still be a bad decision if the timing is wrong. Most people think that investments fail because they chose the wrong asset, or they selected the wrong stock, or they didn't have enough money at the right time, or they missed a particular special, unique opportunity. In reality, most investments fail because the investor needed the money at the wrong time. Let me explain with a simple story. A few years ago, a friend of mine received a bonus, and she asked where she could invest it. At the time, I was investing in ETFs, so of course, I suggested that might be a suitable option. She followed my lead, invested in the S&P 500. But what was the problem? She needed that money a couple of months later. That year, the market dipped. And when she needed to withdraw the money, she had to sell her investment at a loss. Here's the interesting thing. The S&P 500 has grown at an average of 10% year on year over the last 5 years. So the investment wasn't bad. So was my friend just unlucky? No, the timing was wrong. Quick reminder, everything we cover is for information only. It shouldn't be taken as financial or investment advice. If you do need personalized financial advice, please consult a licensed professional. When it comes to investing, I like to think in 3 buckets. Short-term investments. So this is money that you will need soon. If there's a chance that you will need your investment in the next 3 to 5 years for rent, for your mortgage, for down payment on a property, for a possible emergency, then it doesn't belong in the stock market. A classic example is your emergency fund. The priority for this bucket is certainty and access. So when it comes to short-term investments, in the UK, I personally prefer high-interest savings accounts. However, if it's money that you definitely won't need in the next 1 year, maybe you can keep it for, say, up to 3 years, but not up to 5 years, then you can consider other options like mutual funds, government bonds, and so on. Now, let me talk about premium bonds here because I mentioned government bonds. This is something that a lot of people like the sound of, and it sounds interesting, but I typically don't invest in it. So what exactly are premium bonds? It's basically a lottery. The way it works is you put the money in the premium bonds and you could win nothing. You could win £25, you could win 50, or you could win all the way to £1 million. It's a gamble. But if you look at the stats, how often do people actually win those numbers? Then you begin to realize, on average, you're lucky if you just get 4%. Your chances of winning £1 million from a premium bonds, it's very slim when you look at the reality and when you look at the statistics behind it. I would rather just bet on certainty. Go to a bank, they are offering me 4.4%, then I put my money there and I go to rest for the rest of the year. I would rather go with 100% certainty of getting 4% than a 1 in a million chance of getting $1 million. And the interesting thing is, NS&I, the bank that offers these premium bonds, they have other savings products that you can go for. I got that question once from a friend a couple of years ago, and she was asking me, what do I know about it? That it sounds like fun. She wants to buy it for her kids. And that's how it's positioned, like buy premium bonds for your kids once they turn 16. We'll talk about what you can do for your kids when it comes to financials later. But for now, just know there are better options that you should consider when you're looking at your short-term savings. Now, the part that I really like, medium to long-term savings. This is money that you can leave alone for over 5 years. The real difference, in my view, between this and the reason I call them medium and the ones I refer to as long-term, which we'll get to later, is access. So it's money that you do not need from 5 to 10 years, but if you do want to, you can liquidate it. So if you buy shares, ideally you should leave your shares and let them sit for 5 to 10 years. But if you want to liquidate it, if you really, really want to, you can. It's not a great idea, but you can. So those are the things I class in medium-term investing. But ideally, the kind of money you put here is money that you know you will not need it in the next 3 to 5 years. You don't need it now. It's not a down payment for your property. It's not emergency fund. It's not money you are going to need soon. Typically, like I said, it's more liquid, so you can access it. It's typically not your retirement money either. Although, if you're like me, you could use it as your retirement money. You could just decide, I'm going to leave this stock portfolio here for the next 20 years. Your call. And of course, I've hinted at it. This is typically where you would start to look at stocks and shares. The difference between this one and short-term investment is your capital is at risk. That's why premium bonds, as much as I don't like them, they're still safer than stocks because your capital is not at risk with premium bonds. Your capital with stocks is at risk. You can lose all your money if you buy the wrong stock. So let me tell you a short story. Years back when I started investing, I thought it's just by brand names. So I went and I bought a company that was just listing then. I was like, this company sounds like they're good. All the politicians at the time were on the board. It was an IPO. And I bought it at about 7 naira per share. It went to 9 naira, then it dropped below the 7 naira and started to drop and drop. For years after that, it stayed around 1 naira, close to 100% loss. I eventually got rid of the stock because I was just tired of seeing it in my portfolio. By the time I got rid of it, by then I had learned how to actually identify good companies to buy. And one of the lessons I learned then was never buy an IPO. So the moral of the story with medium-term investments is your capital could drop, but because it's not money you need in a hurry, you can wait, especially when you invest in a globally diversified ETF. You can actually wait. If there's a market crash or a market correction, you can wait it out and let time lift up that investment again. If we look at an example of someone that invested around the 2008 market crash, all they had to do was buy a globally diversified ETF and wait. If they bought that ETF right before the crash, it would have looked like they had lost their life savings. But all you had to do was wait, because within 5 years, the market had been corrected. It seemed like the end of the world to a lot of people at the time. But within 10 years, we're talking 2018, and things were really booming. So if it's money that you can wait 5+ years, then here we'll start to look at things like stocks and shares. But if it is money that you need urgently, then it's in the first bucket. So like we said, unlike with a savings account, the total value of your assets here can go up and down over time. Your capital is at risk. That's why that disclaimer exists. The value of everything goes up and down over time. But given enough time, when you have enough time to stay invested, it tends to trend upwards. And most of the time, it will outperform your short-term investments. So that's why we can't just sit everything in the safe bucket. Because when you're talking about returns are generally correlated with risk. So the higher the returns you're expecting, the higher the risk you would have to deal with. I think the biggest risk here with medium-term investments is if you do need that money during a market crash. But that's where your emergency funds should kick in. Now, the third bucket is for money that you can leave for the long term. Now, this is money for the distant future. Stuff that you don't expect to touch until you are probably ready to stop working. Or stuff that you might even want to bequeath your children. Talking about generational wealth. So that's the kind of thing that sits in long term. Here, you can leave it for more than 10 years. It doesn't matter if the value goes up and down in the short term because you are not going to touch it for a very long time. By the time you need it, the value would have recovered. Typically here, when we're talking about things like pensions and property, it tends to be a bit more conservative actually than the middle part. So here, time does most of the work. One asset that everyone has when they start their investment journey is time. Usually, when you're younger, you have a lot of time to invest, but not a lot of capital. As you grow older, you have more capital to invest and less time. But at the end of the day, time is something everyone has in some form or the other. And it can actually help grow your capital. So in this third bucket, we're talking about things like your pensions, like property, It still includes shares if, like we said earlier, if you are the kind of person that wants to just leave your investments for much longer or probably leave it for your kids. But usually, the way I differentiate them from medium-term investments is they are usually not as liquid. So typically, you can't get your pensions until a very long time. When it comes to property as well, you could sell your property, but most people would tell you that if your goal is to benefit from property prices going up, then it's best to just give it enough time. Usually, such investments are not as liquid or as accessible as medium-term investments. So it actually helps you because you can leave it and benefit from the compounding. Now, the truth is this. When it comes to investing, the problem is usually not market volatility. In most cases, is urgency. Urgency destroys compounding. When I say compounding, I'm talking about the value you get from your money making money, and then the money that your money made makes more money. That sounds like a tongue twister, but that's essentially what happens when you leave your investment sitting for a long time. But the reason urgency is the enemy is because you only lock in losses when you sell. The value of your investment only gets crystallized when you sell that investment. So long as you don't sell, whether the value of your asset goes up or down, it's on paper. It's only real when you sell at a particular price. Let's say you bought a stock for £5 and then the next day the price goes to £10. You've not made any profit. If the price drops to £2, you've not made any loss. You only make profit or loss at the price that you sell it, not the price that the market is showing you today. You could say the value of your portfolio went up, the value of your portfolio went down. It's fine. But that value becomes real, becomes crystallized only when you sell. So that's why urgency is the killer, not time. Again, this only buttresses the reason why we need emergency funds. You should never be forced to touch your investments at the wrong time. That's what your emergency funds are for. So even when life happens, your emergency funds should be such that they can act as a buffer and you don't lose the benefits you would have gained from staying invested in your medium to long-term assets. This is what allows your long-term investing to actually work. Now, to the fun part, let's do a quick exercise. Pause the video and write down how much of the assets that you have is short-term. That would include things like your emergency funds, savings in the bank, cash-like investments, property down payments, stuff that you know you're going to need in the next 3 to 5 years. How much of it is medium? How much of your investments in general can you leave and ignore for the next 5 to 10 years? And how much of it is long-term? That will probably include your pensions. If you have property, it will include your property as well. Stuff that you really don't plan to liquidate in the next 10 years or more. If you're unsure of which bucket an asset belongs to, there are 2 questions you can ask. 1, what do you need it for? If you liquidated that asset today, what would you need that money for? Now, that thing that you need it for, when will you need that thing? All right. If there's no concrete thing that you need that money for, then it's probably not short term. If there's something you're saving towards and you need it in 3 to 5 years, then it's definitely short term. If it's something you're investing towards, but you can wait, it gives you an idea, it's probably going to be that medium or long term. But you can use those 2 questions as a clarifier. Now, when you look at your medium and long-term assets, especially your medium-term assets, because you know what we said, that you still have access to those medium-term investments. Ask yourself this question. Can I really leave this money untouched for the next 10 years? If you're looking at your stock portfolio, can you leave it for 5 years? If the market dropped tomorrow, would you have had palpitations? Would you be worried if the stock market crashed tomorrow? There's a simple rule that you need to keep to. Never invest money you cannot afford to lose. You see this on different websites and so on. The value of your investments go up and down. Capital is at risk. Now, I'm not saying this to scare you. I'm saying it so that you understand that even when you invest responsibly, there can be temporary setbacks that would affect the value of your assets. If you cannot be patient and wait out those setbacks, then it's not money that you can invest. Money you invest is money that if there is a temporary setback in the market, you will not be too perturbed. You will be able to wait it out. Now, even if you're in your 40s or you're in your 50s, time horizon varies as we grow older, but there will always be a way that you can estimate how much can I leave untouched for a minimum of 5 years. That if there is a market correction in that period of time, I'll not be worried, because the truth is you need to have something allocated to each of those 3 buckets. You can decide to stick with safe investments only, but the trade-off is that you will lose the growth opportunity that you get from time. You will get some compounding, but if you are only getting 4% returns, then you won't get a lot. Medium and long-term investments have the potential to really accelerate your wealth over time, but there's also the risk that you need to keep in mind. So there's a simple rule. My own rule is slightly different from what you will see on a lot of investment websites. Never invest what you cannot lose. My slight modification of that admonition is never invest money that you cannot ignore. If you can ignore it for at least 5 to 10 years, then you can invest it. But if you cannot ignore it, if you're going to be checking it every morning, expecting the price to go up, if the price comes down, you won't be able to eat breakfast, then don't invest that kind of money. You need to invest money that you will ignore, that you can just be automating into your investment account and forget about it for years. And let's see what happens with time. So ideally, you should be able to set and forget any stock market investing, but we'll build on this later. So that's it for today. If you have any questions on what we discussed, please leave them in the comments. We've looked at the number 1 criteria for deciding the kind of investment that you would focus on, and that's time. But before we start talking about the stock market, we need to look at something else that quietly destroys a lot of our returns, and that's tax.